All right, everybody, welcome. Happy Tuesday afternoon, September 19th. You are here today at our monthly unemployment and inflation webinar update. This is our monthly webinar where we geek and nerd out on the economic indicators that govern our world and govern your job search. And with us, we have back Dr. Riley White, Professor of Finance at the University of New Mexico and the Associate Dean of Teaching. He is back with his humor, his insights, his random outbursts, if you will call them, to tell us how these economic numbers are affecting your job search. You, as the viewer, are encouraged to ask questions, provide your insights, place your comments in the peanut gallery, whether it be on Facebook or within the webinar chat. And so that we may get through this and understand how crazy everything currently is right now and how you can navigate that crazy. All right, we're looking forward to what you have to provide us today, Dr. White, and I'm going to go ahead and hand it over to you.
Thank you so much, Albert. I'm so grateful to be here today. Here are the Albert's List August version of the job report. Here, of course, reported in September, as we're always a month behind in the nature of when data is released. Welcome, everybody, and thank you so much for being here. And thank you so much to the regular audience in particular who have come here and emerged out of the ether to talk about this. We have a lot of things to talk about today, of course. I want you to continue to ask questions as always. And if there's anything that you'd like to talk about today in particular, let me know. We kind of had we were freewheeling a little bit on China. I was going to do a Chinese deep dive. I didn't have time for a Chinese deep dive today. I'm going to have to wait till October for that because it's been presentation season where I'm at. I had the New Mexico Bankers Association on Friday. I've got the Mortgage Financing Authority tomorrow. Everybody's got questions and I've got a limited series of answers and also a limited series of time. And you're out here and it's the coolest part. I'm so honored to speak at all these things, but I have so many things to talk about. So let's talk a little bit about our August jobs report, where we are, what it looks like, and what kind of shenanigans transpired. So when we talked about August, we're dealing with fewer jobs than expected, again, in a different way. And superficially, I want to reiterate, this looks very similar to last month's job report. Indeed, the initial numbers are exactly the same, 187,000. But the key is in the revision. So we have some other news. Labor force participation actually went up slightly, but we had unemployment rise to 3.8%, mainly due to more people entering the workforce and a slight boost to participation rate. That's good. But when we looked at the unemployment change between July 2023 and August 2023, we saw most of that, and interestingly, in healthcare. If you've seen a very robust sector and one of our most fascinating sectors in the American economy, just by aggregate size in terms of the GDP that is generated from this space, is healthcare in particular and social assistance, generating 97,000 jobs. Healthcare is something that proves particularly robust regardless of the economic circumstance and is particularly prone to overarching demographic concerns. We're getting older as a population. We're not particularly healthy as a population. Our life expectancy is dropping as a population, and yet we have more investment here in these areas. We also have leisure and hospitality shooting up the level to about 40,000. Another factor of the summer season, I think we can hold there because of all the losses that we sustained back in the COVID pandemic. Construction still has been robust. We're going to do a little bit more detail on construction coming forward about why this may not last and why there's some concern involving residential construction as we go forward. And this is a really interesting phenomenon. And again, you have a series of other sectors that are doing kind of okay. Manufacturing, government have been adding jobs again, which is very interesting. They've been adding more competitive pay packages. There's some recent stories you've seen around this and other things as well that is able to do this. So it's a very interesting phenomenon. So when you think about social assistance, Scott, that's a really good question. Nonprofit organizations that deliver those in need. In social side of this might be things like social workers, other forms of healthcare that involves health practitioners, social workers with specific requisite expertise as it falls under nonprofit or for-profit institutions. So generally speaking, social assistance in this way is classified incidentally under NIACS, the National North American Industry Code 624. And that's kind of what's included with that. So it's family services, community food and housing, vocational rehabilitation services, and child daycare services also fall under this. So social, it's like healthcare and then social assistance. So it's a big, huge net of all these other things, Scott. That's a great question. And then you have a bunch of sectors that aren't doing particularly well. You have some that are pretty flat, everything from financial to education to educating people about finance, which is my job, to utilities have not been doing pretty well, but they haven't been doing pretty badly. At the bottom of the list, we've seen numbers for mining and logging, information sector, a disappointing month, losing about 15,000 jobs, and then transportation and warehousing. If you remember, the COVID pandemic sort of aligned some of our supply chain issues. We had the tendency over the last few decades has been to approach this global supply chain, looking at things from a different way and looking at these very intricate, very long supply chains that are also very prone, as we found out in the pandemic, to being disrupted in a very catastrophic way. Any link in this chain breaks and suddenly you have an inability to deliver products and services, prices go up, or production just halts. And so there's a lot of variation here that's causing a lot of these questions. But transportation and warehousing investment soared during the pandemic. We got more people involved. We onshored. We did all of this investment. And we're seeing some of that kind of taper off a bit as the need for transportation, as supply chains have come back. Then we haven't seen the same need for transportation related technology, transportation related employment like we did during the pandemic. It's still important and more important in aggregate in terms of employment than it was pre-pandemic, but we're seeing a continued adjustment as supply chains get back in order. And we're not fully insulated. I mean, some of this is we didn't fully onshore in the last 2 years and we called it a day, like, oh, look at these factories everywhere. No, we're actually still very much global, and we changed where some of those sources of global supplies are. And we are wary about China and we are wary about other places, but many of the fundamentals of our global supply chain remain more or less intact, despite the investment in onshoring. And so Charles asked in the open-ended question, is New World Order by Ray Dalio accurate or fear-mongering? Wow, that's a great question. So let me think about this. So like, are you thinking, the world order? Let me see how Ray Dalio defines that. And let me see if I can answer that. And this is interesting. So let me see. So Charles, in your own words, I could probably weigh in on that per se. So if we look at empire, if we look at in the broadest sense of Dalio's like thesis, looking at questions about say one nation becoming more powerful and becoming a nation state as well, it is true. There are some aggregates that I think are true. And I can speak to this without knowing precisely what Ray Dalio's individual claims are. Since 1945, this has been very much a US-based hegemony across the world. So in 1944, the Bretton Woods system was introduced. And Bretton Woods is named after a hotel in the White Mountains of northern New Hampshire, where the United States gathered about 44 allied nations together to kind of figure out what the world currency would look like, the world economics would look like after World War II. What happened was, of course, we ended up in a situation where the US ended in a very favorable situation. The world agreed, or the US led the world to agree. And to note that we were the only nation at that time, of course, that was basically the major nation that was undamaged by World War II and in the way that other economies were. And so the US dollar became the basis of the world system. The US dollar was the only currency convertible to gold. All other currencies to buy gold had to go through the US dollar. And that's for one reason why oil is priced in dollars across the world and commodity prices are priced in dollars across the world. And so countries had to keep the US dollar as a reserve or a reserve currency. And that had very long-standing benefits to the US economic system. Not only did it make dollars necessary to be held globally, but it also improved our trade links globally. It improved our markets globally. It led to decades of economic growth and development. Even after the gold standard collapsed in the early 1970s, the the US dollar remains a reserve currency today. Now, the tricky part about this is, and this is the really interesting phenomenon, it's still used in the majority of international transactions involving currency transactions. It still goes through the dollar, or the dollar is one of the two currencies traded in a majority of these cases, which is a phenomenal thing to happen. Our economy represents about 1/4 of the world's GDP, and yet we still hit above our weight, so to speak, with regards to the amount of power the dollar has. And so this is when we think about world orders and changing nation states, when the US benefits dearly from this, not least in terms of commodity pricing and other things, but also in our ability to take out debt for very cheap amounts of money and those kind of things. It is likely going to shift. And as you see growth in economies in nations like China and India, and this is not news to anyone per se, but eventually, we're going to reach a very different equilibrium. And it's probably impossible for the United States to maintain an equilibrium that is at a level that can maintain it internally. There's been a lot of talk about is the dollar going to decline in the next coming years, or these things, a lot of things saying, oh, it's the end of the dollar. That's not the case, because it's still considered not only a reserve currency, but it's a store of value, and it's somewhere safe that people can park money for long periods of time. And so it's whenever we look at a shift of systems, barring something like a colossal crisis, a war of epic magnitude, the US loses, we have a new system, it will evolve generally to be a more inclusive system, but it's difficult to say what that is. And when you are the existing system on top, there's a lot the United States does as a nation to keep the dollar still in a predominantly important space in the economy, in an important space. So I think it's possible, but I think the transition can be very gradual, and it can happen over a very long period of time. But it accelerates in periods where, for instance, we have national level crises and things that will cause that issue. And Albert says, the BRICS nations keep trying to create a new currency, even though they hate each other. They do. And they're working very hard to do so. And the problem is, and they're convincing themselves of their own importance. The problem is, of course, and they can, and the BRICS can have their own alternative currency adjustment or alternative metric to do it. I would suspect that at some point, some weighted, one of the weighted pools of currencies would make more sense. But it's hard to do. Some of that's down to simplicity. Dollar has replaced the gold as something that everyone understands has value in it, which is why people use the dollars more often. People want their currency to have the value of the dollar, and that's very hard to do. Oh, yes, these are great charts, by the way, from Aaron, in noting our reserve currency criteria, candidates, and consequences. The US dollar is a dominant factor in global currencies still. 57% of global reserves. And that's the number I'm looking for, Aaron. Thank you for that. Very solid charts that Aaron is posting too. Very nice. But anyway, that's the deal. So it likely will change, but when you think about the New World Order, Old World Order, Middle World Order, these are accelerated at times of economic crises. Something like a war the United States loses to a major power would be a very bad thing, and that could be a source, a catalyst for a change. Apart from that, in peacetime, the United States will try likely to maintain dollar hegemony as any way that they can, in very indirect ways, in ways that is just convenient to do so, because it takes a lot to get people to change practices. So there's a lot of things at stake in this. I love that question, Charles. That was a great question. So anyway, we got some things here about where these jobs come from too. Labor force participation rose slightly as well, which was good news. More people back in the workforce, still not where we were pre-pandemic. And I don't think we'll ever get there, mainly because demographics in particular. We are getting older, people retire, that means that they leave the workforce. Hourly earnings were interesting to watch in this last number as well. It rose about 8 cents to $33.82 per hour on average. This is annualized only a 2.9% increase in wages, only 4.3% over the course of the year. One worry about inflation is, are wages going to rise at such a level that we're going to see inflation at catastrophic levels again? And it doesn't appear to be that case. To get inflation that lasts for a long time, you need to pay people more money, and people are not being paid at the level that would generate long-standing inflation above, I say, a 2% target the Fed chooses. 4% is not bad. It's good wage growth, and certainly real wage wage growth is important, but it's starting to slow. We're starting to see cracks in our overall picture of the job market. And importantly, there's been two important downward revisions included with this report. The June numbers were down 80,000. We thought 185,000 new jobs were created in June. Actually, it was only 105,000. And then in July, we had similar numbers, 187, actually only 157. The trajectory of these have been downward, which is not good for the overarching economy as a whole. And it does show significant slowing in the economy, which is what we expect to happen. So moving down the list here, let's talk about a little bit about the inflation rate right now. Yes. So Albert asked the question, what goes in the revision from BLS? The short answer is more data points. They have an existing survey that comes from this, and they additionally follow up with additional data that they get from employers and other corporations and other individuals that allows the survey to be a little bit bigger and a bit more accurate. And it just takes longer and a greater amount of time to collect this. Are these jobs that were meant to be open but didn't end up being open? That's a good question. They're just doing corrections based on the revisions from their prior estimates as new data has sort of comes out. Economics is a hard science. It's particularly hard because data is hard to collect meaningfully in ways that make sense. And even right now, when we extrapolate things like the employment rate, we're using a sample set of data from a survey that is statistically pretty good as a predictor, but it's an imperfect predictor of the market as a whole. Any chance that Biden administration could be initially juicing the numbers to look good only to revise downward later? That would be catastrophically unethical. And I sure hope that wouldn't be the case. And revise downward quietly, like, hey, just do this way. I don't know. It's very difficult to say. This is decisions that will happen at the level of the Bureau of Labor Statistics. And I could imagine there's some economists there going, well, let's just shoot for the high numbers. And then if it's a little bit lower, I can keep my job. I don't see it as a directive from above. I see it more likely as the way that people are processing numbers internally. We all have wishful thinking in some regards, and it's hard when things go down. But it's also more likely to have downward revisions in times where there's economic concerns and things that we don't fully encapsulate with an economic change. So things about CPI inflation. So one of the two ways, we have PPI, CPI, the consumer price index inflation. Inflation has still cooled, but notice that it went up to 3.7% in the last number, which was above the 3.2% we saw last month and above the 3% number where it bottomed out 2 months ago. There's a couple reasons for this, but we know that inflation just isn't one thing. It's a whole bunch of shenanigans put together. And so our total CPI is that yellow line here. This is a graph from Joseph Politano. I love his graphs because they're clear and concise and easy to read. Always good factors in all things. I'll even like it so much, I'll blow it up for the people in the cheap seats. When I go to the presentation mode, sometimes it gets screwed up. So that's why I like to come here and screw around with it. So breaking down CPI inflation, the yellow line, we were steady. We didn't have inflation. We forgot what inflation was in pre-pandemic. It shot up, supply chain issues, an influx of $5 trillion in stimulus spending, all the way into 2022, peaking at 9.1% in June. And then since then, it's gone downhill. The Fed raises rates at the highest level we've seen, at the highest rate of highest rate of change we've seen in 40 years. And so what happens is it gets harder for companies to invest. The economy starts slowing down. Inflation slows down with it. And we have inflation going down to 3% 2 months ago. Now it's up again. Fuel prices are some of this matter. And indeed, fuel, which was a decline in gas prices that we had seen in the last few months year to year fell off, and it was a tailwind for us. It helped push inflation lower because some of those declining fuel prices helped lower inflation rate. Now fuel is back up in price again. That means that it's continuing to even out or even potentially increasing in the winter months what we see for inflation. The general tendency is still downward, and that's good. And the big picture that I want you to take away from this is inflation is very much on a downward trajectory, even as this happens. So if we look at the CPI number in orange, which is excluding food and energy, you're seeing that steady decline that we've seen in the last few months. And in green, we're excluding food, energy, and shelter. That's that measure the Fed likes, right? They like that core CPI, looking at not things like food, energy, or shelter. Oh, the things that matter to us on a day-to-day basis. That's going downhill pretty significantly. And then you have food, energy, shelter, and used vehicles. Now, I don't necessarily agree with this metric as much because used vehicles vehicles. I mean, looking at, say, the United Auto Workers strike or other things, there's a lot of prices in the vehicle market right now that might be variable, but that itself has gone downhill. So don't rest your laurels on one aggregate CPI number. Look at what's actually happening, and it seems pretty good in the direction. Any early insights so far from the Fed meeting that started today? This is a really good question. So I think there's two things that are observable in this, and I won't know fully what those insights are until I have a chance to read the minutes. But right now, looking at the Fed meeting, you're looking at discussion, and certainly the discussion and chatter from different Fed chairs that we've seen has been very telling in the last few months. You have some chairs looking at the question of inflation and looking at the rate numbers and being like, well, maybe we've raised about enough, and others saying that some of this debate that we're seeing is part of a very vigorous debate between different Fed leadership as to what to do now. So it is interesting. We know that Jerome Powell has been unequivocal in his statement that hitting a 2% target is critical. However, for inflation, and that would imply at least one more rate hike. The markets expect another rate hike. We expect another rate hike will happen, if not today, maybe by the end of the year during the final Fed meeting or so. So I think that if they pause tomorrow, I suspect they'll raise in winter. If they pause now, or if they raise today, they'll pause in the next session. So I think we're slowing down, certainly, and I suspect it will happen, but it depends. And I see this being a debate that will happen really fundamentally as you look at different Fed chairs across the country for each of the 12 districts, looking and engaging in various and very perhaps differing viewpoints than they had previously around inflation and what represents enough. And this is splitting very much the finance and economics field right now. Have we had enough rate hikes? I remember a few professors, a few faculty, few experts in the field had argued back, oh gosh, when rates were still like 150 basis points lower, that was enough. And there is a delay in the time that the economy represents and feels the pain of interest rate shocks, and versus the time that they're initiated. And so we haven't seen an incorporation of all of that yet, and this is going to be tricky to see. So we look at things like another way to look at pandemic prices, looking at CPI inflation over the last few years, looking at energy. Energy was that nice tailwind pushing us forward, driving down inflation. Now it's coming back up. That's going to be a headwind going forward. Core services are still where we're seeing most of the inflation right now, as opposed to goods where we were a year ago. So we knew that we were going to switch from an inflation-based economy that was heavily in goods and heavily in other aspects to one that's heavily in services. And that's what we've seen, and that's the most concerning thing. Services, core services, everything from the price of you repairing your car to the price of a haircut. Everything that provides a service to you is rising very quickly in price, and that's having negative consequences. As long as people keep staying in their sub 3% interest rate homes, things remain the same in the short term. I love that question, and I know that that's absolutely true. And I showed this chart a little while ago, and maybe I can dig it up somewhere, but looking in aggregate, most people still have very low interest rate homes. Inventory has collapsed, and as a consequence, you're not seeing a lot of adjustment in the price of homes. We have really high rates and also really high asset prices. I had a guy come into my office today, and he's like, "Why is that, Dr. White? Why is that?" And I go, "Well, it's a tough market." I said, he did scream. And I went, "Well, inventory is preventing the market from churning." So we're going to see what happens with this, and we're going to see what happens going forward with this. So I want to reiterate a chart I showed you some months ago. And this is a really interesting one about the Cleveland Fed. And the Cleveland Fed had come out earlier in the year with this projection of where they thought the inflation rate was going to go. And they were saying in the absence of a recession, it's going to take till 2025 to reach 2%. And even though it seems so much, we're accelerating downward to 3%. Now we're up to 3.7%. It's going to take a while. But the good news is, if you look at this in aggregate, we are kind of still following along the general pattern of probability of where inflation would lie, according to the Cleveland Fed. And I suspect this will continue in aggregate to be focused this way, barring something like an inflation, which would accelerate the de-inflation or disinflation that we're seeing. But the hard part is, can we do this without breaking the job market? The job market is still good, but it is much more stressed than we've seen it before. And we're close now. We have positive numbers for this, but 100,000 jobs is really close to 0 jobs a month. And we could get there in a couple months. We could wait maybe after the holiday season, but we're getting to a point where we're seeing the economy slow down in very meaningful ways. And so when we think about this, another thing to observe, which has been really interesting numbers lately, and I like this chart in particular because it looks at retail spending divided by age group. So despite where you fit in this various shenanigans here, whether you're over 54 or whether you're under 25, sorry for you're under 25, you're not represented in this chart. I apologize. But if you're in some other area that called the core working period of 25 to 54, you'll notice that retail spending surged post-pandemic. People had more money, but it surged unevenly. Seniors spent less in aggregate than younger folks did in relationship to where they were pre-pandemic. Notice that retail numbers have been holding strong in terms of spending through summer this year, except for 25 to 34, which peaked, not only did it peak at the beginning of the year, but it's gone downhill fairly since then and against other age groups. Some of that is likely due, perhaps, is it perceived weakness of the job market? Is it student loans, perhaps, that's causing this, or concern about student loans that's causing this, and other expenses that are related to this? And so in the 25 to 34 age group in particular, you're seeing a decline in spending that isn't being seen in other areas of other ages of the economy. Oh my gosh. So Albert says, right now we are seeing a September surge in job listings. Look at that. What do you think that will do to inflation? That's interesting. Job listings, and will the jobs be filled, and at what pay will the jobs be filled at? And if the jobs are out there and there's more of them and they'll be paid more money, and you're seeing price pressures, then you can see that as an inflation driver. If there aren't price pressures and companies are filling in positions they had previously laid off, that's a separate question. Or maybe they over laid off employees. I have to figure out where these job listings might be, because we know I get the aggregate numbers. I may not know specifically the local numbers. It'll be really interesting to see how student loans will influence this. I agree completely, Albert. December to February, exactly. That's when we'll start to see more of this picture happen as people have to repay those student loans. That's going to hit the economy too in a negative way, because that means less spending in certain areas of the economy. And so, okay, Riley, where's this recession? You told us a while ago. Are we going to have a recession? What kind of shenanigans are this? And you're all smoking your cigars saying, Riley, you promised me a recession. I had the mayor of this town in New Mexico come to me, one of the largest cities, and he's like, where's my recession? Where's the recession you called, Riley? And I said, there would have been one in March if the Fed didn't step in and prevent the regional banking crisis from becoming a national banking crisis. But there are still signs on the horizon. And the fun part is the pendulum has swung from us being worried about a recession to now being a bunch of pundits saying, oh, there's going to be growth now and sunshine. And we're at this bottom portion and things are going to be great now. So I can't get on that bandwagon yet because of all the data that's still out there that shows there are some issues on this as well. Oh, this is great. Look at this participation rate data here. This is good stuff, Aaron. Man, solid stuff. I really appreciate that. Let me also look up one piece of data here. So we had a 0.2% rise in participation rate, which is pretty substantial. But Aaron has a way of looking at the participation rate in this link here that actually divides it by different age groups and different categories. And so right now in the working age picture, the 25 to 54 age picture, 83% is as good as it gets, or 80% is as good as it gets that we can get here. We are tending to, the cool part about this, they're projecting 2032 in this. And you can see that there is a projection that participation rates are generally going to come down, with the exception of 55 to 64 in general. That age group is expected to have more workers, which is interesting. The anticipation that people will be healthy enough to continue to work, which might be optimistic, but we'll see what happens. Oh my goodness. Charles said, is it possible that MGM casino hack may cause a recession in Nevada? That's a really interesting question. Can we get a local recession? Sure, absolutely. One could argue that the Great Lakes in particular have been in a recession of some kind for some time since the 1960s. And it's possible to do this. I think a gaming question, and what's really interesting in the sense, less so on gaming specifically or casino-related hacks, does it affect spending to Las Vegas? And not arguing that the Nevada economy is entirely Las Vegas. Las Vegas just happens to be the largest portion of the Nevada economy. They're heavily reliant on tourism. They're heavily reliant on a number of things that go above and beyond the gaming industry. I suspect in the sense that travel numbers have been robust, that we're not going to see a Nevada specific recession, given that so much reliance happens in leisure and hospitality from the tourism sector itself, going to Vegas for what Vegas is, rather than necessarily concerned about that. And that's really interesting. And Marcia, that's a great question, Marcia. Good to see you again, Marcia. Government is threatening another shutdown, just another day. Oh my goodness. So the government shutdown does have an economic cost attached with it. Unlike, the interesting part is we're looking at it feels the same, but it's somewhat different than our previous worry about raising the debt ceiling. When we raise the debt ceiling, we risk actual default to the US economy. And when we default across the US economy, that means that our credit is ruined, and then we have like long-standing, decades-long effects that could ripple through the cost of our debt. Government shutdowns are things that we've had before, not to say that there's sunshine and rainbows. And particularly if you're working at Livermore or have friends and family working at Livermore, if you're in work that's tied to the federal government in some way, either through the Department of Energy, national labs, other things like that, you are at risk of downsides when it comes to things like government shutdowns. Mainly because, while you will get paid ultimately for this, you see furloughs, and furloughs are, of course, are a huge personal cost for millions of potentially millions of government workers should the appropriation bills not happen. So I think it's very important to watch this, even though it is just another seeming endless array of our dysfunctional government and their inability to get agreements done together in a meaningful way. It is going to be a potential problem. And a shutdown at the end of the month and the furloughs it causes will cause stress for consumers already. And would it be stress enough to cause or initiate a recession? In itself, probably not, but it will be a substantial effect that people have to grapple with, and it will curb spending until people get paid back. It's a fascinating situation. It's horribly, horribly fascinating. Colin says, if you want Lent to Uncle Sam will visit you with an army and ask one final time. That's nice. That's I love the level of you know, what do you call this? The jingoistic level patriotism in this thing. Sean says the level of student loan payments could affect the economy, especially retail and housing, as borrowers allocate $200 to $300 monthly. Absolutely. Although economists say the saved money was a small part of spending, the overall impact could be significant, particularly in housing. Sean, I think that's correct. I think many borrowers are already not making payments. We're going to talk more about the debt situation and more. So we're going to talk a little bit about what we think will happen, and it will certainly stress out things in interesting ways. So let's take a look now at the macroeconomic picture. We still have an inverted yield curve. There's our number in September. Inverted yield curves have predicted 8 of the last recessions. It's still negative, and it's even more negative than it was last year when it also predicted a recession. We also have our leading economic indicators. Although they have not continued to go downhill, they remain in strongly negative territory, which suggests that a recession might happen. But again, there are distortions as well. The COVID pandemic caused a ton of distortions in the marketplace that the economy is adjusting to. So when we think about this as well, so what are we seeing from the companies out there right now? So let's look at high yield in particular, high yield credits, high yield bonds, high yield companies. Another way to say, if you have a high yield bond, it's also called a junk bond. These are riskier companies. So a good example, Caesars. A lot of casinos are high yield and high risk ventures. What the question is are we seeing additional stress for these companies because of higher interest rates? And the answer is yes. Our interest coverage ratio, which is the company's ability to make profits above what they actually have to pay in interest, is going down. That means, although they're still pretty good, they're not as bad as where they were during the nadir of certain recessions. They are in a downward trajectory. Also, interest expenses are growing at a rapid pace. And the only way to eclipse interest expenses or make up for the higher interest expenses are to make more money or to make more profits. And so we're seeing companies under significant pressure. So are companies making more profits? And as it turns out, not really. We're seeing right now, if we look across the board here, we have a 6.5% year-on-year decline tough to see here, but as you can see, this is the profit change across the US corporate profits aggregated, and then we take the percent change here, down 6.5% so far this summer year on year, which shows that we are still seeing stress, in particular stress around companies and how they view how interest payments in particular, and saying a leveling out of consumer spending is eating into their margins. We haven't seen a decline of 6.5% or more since the immediate pandemic, as well as during previous recessionary times. Interesting. So companies still are under stress in aggregate, and apart from a few of the big players in the market right now that have driven a lot of the stock returns we've seen, it's been kind of a rough show out there. Now, household debt, tying it back again to consumers, bringing it down and saying, what's going on with people? How are you feeling? Do you have more money than you did last time? Do you have less money? So the share of households that are reporting it is harder to obtain credit now than it was a year ago. Whoops, sorry about this. I'll move this around here. There we go. We'll just move loan balances around. So the share of households reporting it's harder to obtain credit is at 60%. That's higher than we've seen in this survey since it began about 10 years ago. And so far, that's not good. And so you look at total debt balances, and there's many ways to look at this chart. Many have been manipulated one way or another, but the idea is this. So total debt balances are high. Now, as a percentage of household debt, it doesn't look that bad still, meaning that in relationship to other things, and even revolving debt, which includes things like credit cards, we're still not at the highest levels we've seen or anywhere near it per se. And so the question is are consumers feeling good or not, or less? Are they feeling well or less well about the economy? So we know that automotive loans have hit astonishingly high rates. We've had a double-digit numbers of people who are paying $1,000 or more for new car payments, which is just an obscene amount of money for an average person to pay. And it's very challenging because this is high across the board. Not so bad, incidentally, and I'll show you what I mean by this. I'm going to grab a chart here that looks at this. So let's look at automotive loans in more detail. This is the percent of state residents who pay more than $1,000 a month for their new car payment or new or used car payment, but they've had to buy a car during this period. And what kind of payment did they commit to? And a huge percentage, particularly in Texas and Wyoming, about a payment of $1,000 or more. A lot of these states are heavy on trucks, which help push those payment numbers higher. A lot of the Intermountain West are paying 20% or more for $1,000 payments. And then even in California, about 19% overall. So astonishing numbers for depreciating assets. And automotive interest rates have come up to such a level that right now, on average across the country, you have a good credit score, you'll likely pay more than 7%. With a less good credit score, you're going to be even lower than that. To give you a sense of that, it'll be more like 11% for those other numbers. And so these things mean huge things. Only credit cards are high interest resetting, Aaron points out, and that's a good point. Automotive loans, as people get them, though, to your point, they do raise an aggregate because we are expecting that people, as their cars wear out, the average person holds onto a car for about 8 years, as opposed to 12 years for a house. So they do have a greater amount of churn. And unlike things like a house where I can choose to move or not to move, I still have to get to work, and whether or not my car catches fire on the way dictates whether or not I'm more likely to be able to need a new car, to have to commit to a higher loan in a short amount of time. Yeah, that's think. You think auto people will keep them at least 2 times what they were between 2019 and 2022? That's probably true, Aaron. We haven't observed a lot of the consumer changes that we're seeing in this either. Credit card and student loan debt, all very high. So what does this mean in aggregate? And this is the real number that I want to see is let's talk about the question of delinquency. So there's the question of credit as it pertains to I'm going to put this behind. I'm going to send this to back. Well, we look at the delinquencies by type of debt, looking at the delinquencies that we have by that are out there right now, meaning that these are loans that are delinquent and often unrecoverable potentially from banks. And you can see that the trajectory has been strongly upward. Interest rates are rising. That's made payments harder. But we're not at the level we saw in 2008. Is this time to celebrate? Absolutely not. I'm very much a trajectories guy. You can see that consumer loans are up in their delinquencies, rising from 3% mid-pandemic. Now they're approaching 6%. For auto loans and credit cards, you're dealing at rates above 3% and almost 4% in both of those categories. These are the highest levels that we've seen since right following the Great Recession. And the trajectory of this is important. So I can't get behind the assumption that I've seen in some marketplaces that this represents the start or new initiation of a growth economy until I see the trajectory on these delinquencies start dropping. And I see a lot of reasons to suggest they'll continue to rise, not least because we have student loans on the board and we have other things coming online that will make it harder for consumers to pay their bills. Such a challenging environment, such a challenging environment. But you see where I'm coming from there. So there's the big thing. So delinquencies as a whole are not higher, but they are rising, and they're rising in very interesting ways. Auto loans as well. When we look at delinquencies by age, young folks in particular, and this is really devastating to credit scores early on, you're seeing increases across the board in auto loan transitions and delinquencies post-pandemic 2023, particular in the 30 to 39-year category. Automotive loan delinquencies are approaching levels that we had back in 2008. They remain low and depressed for higher and older folks as well. And so this suggests that a lot of this is still not ubiquitous to our system, but it's something that we need to watch. So Colin says, yeah, look at this stuff. We all kinds of stuff here. Hold on. Albert says, everyday Joe's getting squeezed. That's true. Colin says, does the UAW strike and demand for 40% increase in pay affect any of what we just covered? Colin, I like your questions, Colin, because they always sound exactly in tone like my students ask questions. Does any of this matter when it comes down to this? And the short answer is yes, of course. So United Auto Workers strike, of course, is estimated to cost, if it lasted for like 45 days, it would cost on the order of $40 billion to these companies as well as the overarching economy. So ways where you could see the effect of the United Auto Workers strike is production shuts down certain plants, fewer cars get made, fewer new cars mean that puts upward pressure on used car prices. That means people will commit to used cars, have to pay higher prices, barring inventory concerns and other things. And so it does have reaching effects to other things that affect the market. And it's also unclear. If we look at the profit margins, The Economist had a highlight on this of Ford, the parent company of Chrysler, and General Motors, you're looking at profit margins that are strong in the 12% area, but they're much lower than companies like Tesla right now, which is not part of the UAW strike. And also companies like Toyota overseas, which maintain very high margins right now. And so it's interesting that you're looking at what other aspects of the UAW strike could change is, will it shift? And it makes, the weird part was I read a headline that says it doesn't matter what the outcome of the UAW strike is, Elon Musk has already won. It is true that Tesla, because they're not part of that in their workforce, can potentially represent or can potentially use this as leverage to continue the competitiveness of their cars relative to other cars in the economy. So it's very interesting to see how this pans out. So it affects it in a huge way. And this is the sad part, because UAW workers are asking for increases in wages and other things, which are very reasonable or not reasonable, depending on your view on it. But it's interesting to see that this may affect and it may shift the advantage of car production away from these big three automakers to other places, which is going to be very interesting to see. Aaron says, assuming rates peak in the next 12 months and a stabilizing period for 12 months before rates lower. Oh, that's interesting. We should be peak delinquencies mid-2025. That's true, Aaron. Barring something like a recession or a cause for a recession, I still think we're going to be tested in the way that we were tested in March. We have a credit crisis. We'll have, hedge funds taking out right now a lot of interest in treasuries right now that might cause interesting things happening to the market. We're going to be tested geopolitically. There's going to be a lot of things that will affect the market in very meaningful ways in the next year. So although I can imagine a Fed saying, let's start lowering rates gradually in 2025, it's still hard for me to believe, because the Fed hasn't lowered rates outside of a recession since 1998. And even then it was due to a global financial crisis done in part by the collapse of the Russian ruble on the heels of the 97 Asian financial crisis, which of course involved a lot of different currencies across East Asia. Oh man, this is really good questions. Colin says, I'm old enough to remember when auto workers took a pay cut to keep the auto industry going in 2008. That's right. Colin, you're older than 15? surprises on this show all the time. No, I love it. That's a good question. You're right. And they took a pay cut to support to keep these companies alive. It is interesting, and especially as this plays out and whether it will create these things, we actually see more widespread strike and work stoppages now than we've seen before, which also happens in response to economic inflation and other things, because inflation, of course, in response to higher inflation, people naturally demand higher wages. Very interesting stuff as it pans out. Auto industry C-suite should take a pay cut to end the strike. Bam! Colin, give us back what we gave you back in the day. Commercial real estate, still a problem. 270 billion in commercial mortgages are continuing to expire this year, mostly held by small banks. And I reiterated this to the bankers on Friday. And the bankers were like, well, commercial real estate's great. And it depends where the commercial real estate is and what kind. But there's a lot of uncertainty here, and a lot of these different loans, when they churn over each year, the average commercial real estate loan is usually an interest-only thing, so you don't pay principal down, and so this has to be renewed every year, every 5 years or every 10 years, depending on when that loan happens. So we're going to see continued pressure in this sector over the long run. Another thing to think about, commercial real estate as a whole, small banks are taking on most of it. Large banks have since kind of washed their hands of this and leveled off their commercial real estate debt. Small banks are heavily exposed. And you think about the banking risk of the economy right now. And this is something I want to reiterate a little bit more in more detail. Let's revisit the question of what happened in March versus where we are today. So in March, what happened was, we had uncertainty, not only Silicon Valley Bank, but now we're 6 months on from this crisis. What happened? How do we feel about it? How are banks doing? And so there's a couple interesting things. So when the Fed instituted, or when the Treasury instituted their loan program to support deposits in a lot of these institutions and help prevent some of this deposit flight and ensure that capital ratios were met, it was taken on enthusiastically by a lot of large and small banks alike. This expires in March. It's a one-year facility, one year open option. In the intervening time period, this did a lot to stabilize markets and keep money from flowing out of banks into other places. And if money flew out of banks in mass and we had a lot more bank failures, we'd probably have ended up in a recession if we didn't manage it well. But we avoided it, and so far so good. And so the question is, where are their problems? And we still have problems out there right now, looking at commercial real estate, looking at other aspects about this. Oh, that's a pretty good chart too. The Fred graph that Aaron shows the continued rise of real estate loans. Colin says if large banks are offloading their CREs, isn't that a red flag for CREs? Indeed, when you see a shift from CREs from large banks to small banks, and small banks don't usually possess the diversity of resources that large banks do with regards to managing risk or spreading it through the system. That means that it makes it very hard for these small banks to manage downside risk in the way that large banks can manage them. They don't have the same risk models. Sean is absolutely right. Sometimes their risk models are poor, and sometimes, and this is no shame on small bankers. They do the best they can with all that they have, but they do have limited resources and limited ways to capitalize this data. And so it's very interesting to look at this and how this pans out, because it is going to be a risk. And so I looked at a few other ways that we can measure this and things that we can look at. Are banks healthy right now, or should we be worried? One of them is deposits. And so I went and we looked at, this is data from an exhibit from Bank of America on deposits versus pre-pandemic levels. And so pre-pandemic deposits are still up from where they were pre-pandemic. Bank of America in this particular chart sorts it between yellow line, which is deposits above 100,000, deposits under 50,000 are blue, and everything in between is red. You saw a surge of small depositors after the stimulus money and the recession, and since then people are eating into their savings and checkings accounts, and the trajectory is downward, but yet it is not catastrophic right now. What do we see in the aggregate data? What's the outflow look like? People have choices. Do they keep money in deposit accounts at banks, or do they move them out into higher paying money market funds or other facilities? And right now we're looking at our board. If I split and this is a chart I got from Fred where I added both large banks and small banks separately so you could see them. Deposits are declining. This is common in high interest rate environments where there are other financial products available, but again, they remain elevated where they were pre-pandemic, and they're not by any ways at a catastrophic level. This is very encouraging. If we saw significant deposit flight, I'd be much more concerned, but this shows that banks can maintain deposits at a level to help finance risk and finance economic growth. But again, inflation eats into your purchasing and savings power. And Albert's absolutely right that people now are looking at this and deposit growth isn't rising. It's just not declining at catastrophic rates. But now I want to shift gears a little bit and talk a little bit about our friend near and dear to us, which is real estate. And we looked at this and we had a surge of real estate across the board. And we looked at a bunch of things that happened overall that created all these drastic changes. Nationally, oh gosh, we've seen a surge of prices in asking rents. So we had, of course, at the beginning of the pandemic, as a recap, it's like a PTSD recap if you've tried to purchase real estate in the last few years. But one of the times where we started off with very low interest rates, very low mortgage rates, that incentivized prices to rise, people buying second homes, et cetera, all this kind of stuff, all these shenanigans. But the problem is that eventually prices rose so high, people could no longer afford them. Rates started coming up, interest rates rose, the 10-year bond rose, that pushed mortgage rates upward. That decreased affordability. Then we had a surge following this price surge in mortgages for rental homes. And this rental homes also caused a surge of multifamily unit construction in many places around both the West as well as around the country. And we're looking at rents that are causing this to rise. When people do economic outcome or an analysis based on whether a construction project is worth it or not, they often look at the question of what kind of rents are we expecting to get now or a year from now or 10 years from now, and then how does this affect the economics of this build? And we've seen that rents have risen in such an area that it made some multifamily projects which were previously not feasible economically feasible now, and that becomes important. Aaron says people forget about banking collateral requirements during higher inflation levels as rate term duration risk moves to the shorter end of the curve. I love the level of just discussion that you guys can put forth in this. Aaron, absolutely true. And Collins says, if CREs begin defaulting, how exposed are small banks? If small banks undergo an extinction event, what does that mean for the economy and jobs? So we're already seeing signs that bank consolidation is on the rise. We saw right now, looking at the state of New Mexico, part of the banking association, there's something like 32 small banks. 2 of them have been gobbled up by larger competitors. Across the country, I suspect, Colin, you hit the nail on the head. We're going to see a tendency towards consolidation in this sector. Now, you can maintain a competitive banking sector with a smaller number of banks. The United States has an interesting system. We have a large number of banks compared to a country like Germany, which, even though it has a smaller population, has very few large banks that are able to do a large number of things. There is that tendency here, and there is that tendency where small banks in particular are being squeezed in favor of both technology investment, which is favorable at larger banks, operational costs at larger banks, internet banks at larger costs, and small banks are also squeezed by non-traditional financial service providers. So if you've gone anywhere else that isn't a particular bank for things like a loan, services, checking accounts, other things, or something that you've found on the internet, which many people do, it is now at a level that it's competing very majorly with how small banks typically do this. Small banks are worried that their customers are dying off. They're worried about concerns about how to initiate new investment, and they're worried about not being able to compete with AI and other technologies, which will be critical for banking success in the future. So all that stuff is going to be good. So what does that happen to the economy and jobs in general? So if small banks kind of disappear or they reduce themselves in numbers, it does create a less personalized viewpoint. We don't think of small banks usually unless you're a small business owner, but if you are a small business owner or you're a mid-sized business owner or you're an equipment manufacturer, it does limit your manufacture, it does limit your ability. And it does create the question that has propelled banking in the last 50 years has been relationship banking. Relationship banking is tougher to do with larger banks. And I've worked for a big one and a small one, and I can tell you that it is tougher at larger banks to do so. So Scott says, that's just a great question. Scott says, are the forecasts that people can spend more on rent the next years based on some expectations and other costs of living? Education loans will be lower in that next 10 years. People look at wage growth, they'll look at expenses, they'll look at other things. Well, Scott asked a good question. I mean, basically, what can people adapt in a discretionary way to support this? And I'm going to show you a chart down the line, which shows you that while housing price inflation is a huge part of this, it's also a very much a global phenomenon, and things could get much worse as affordability goes. Because even if we look at the amount of money that we spend on rent here in the United States, we can go across the world to countries like Canada and New Zealand and see many rates that compare, or at least are higher by a significant margin. And that's one of the things that people look at. Are we more likely to become like Canada or New Zealand, or more likely to make housing more affordable? Sean says, housing affordability squeeze is further exacerbated by decline in confidence. Yes, I'm getting there, Sean. That's absolutely right. We're going to talk about that too. Colin says, number one, be a big bank. I'm not going to read it all, but I love it. Profit. Look at that. That's brilliant. I'm so glad. Colin's on a roll. We have too much banking overcapacity in the banking space. We need massive consolidation in middle, lower tier banks in the US. So Aaron, that's a bold statement. I think true in many ways. If you look at the products and services, if you look at what we need and what we can do, I think it will be impossible for small banks to keep up. And I think large banks will be able to utilize technology and technological advantage to produce a better slew of financial products that people can use. So I think they'll outcompete small banks. That's where I'm going with that. But yeah, here's the good news about rents. Supplies increasing across the board for US apartments, which means that we're starting to see some year-on-year changes, which are flatlined for most markets across the country. I know, look at this. That's how I roll. Bold, Aaron. Bold, but I like it. I'm not disagreeing with it. I like how you say, I would, I love the way you phrase it though. You're like, we've got too much banking capacity. We need consolidation. And I'm like, well, I just think large banks will outcompete small banks, but I think we're going to get to the same conclusion. We'll get there the same way. Annual rent growth nears negative territory as new supply ramps. So right now we saw this huge surge in 2022 of rental year-on-year rates. That's since declined. We're seeing supply hit the market. Best way to reduce prices is increase supply, and that's what we're seeing. Now on the other side of this, Sean brought it up. Sean gave you in the chat comments the situation, what's happening in residential. We saw a surge of construction spending for multifamily, as well as some surges for single family residential, but that has since fallen off like a rock. How severely has it fallen off? And this is, as we say in construction, a groundbreaking chart. Home construction now is tracking below kind of the worst negative cycle that we've had in previous history, meaning that at a time when we need more supply of homes more than anything, builders are cutting back. Why are they cutting back? Why is home builder confidence low? New home prices have dropped below old home prices, which doesn't happen very often, and indeed very rarely in the last 3 decades. And that usually means that new builders are having to cut and issue price decreases to accommodate the increase in interest rates. It takes a lot of energy and demand out of the housing system. People who want to build a house or otherwise would be interested in building a house are not. That is sending builder confidence downward. And that's a negative for us, because the thing we need right now is more supply to reduce prices. Now look at another thing. What's impeding things apart from people and mortgage rates in the way that we build things? Yeah, this is really interesting. Aaron, bam. U.S. government should develop FHA 2.0. I agree with you. I have a similar proposal actually tomorrow when I speak to the Mortgage Financing Authority about we need more impediments to expanding developed land supply in the next 5 years. Look at these shenanigans. So this is from John Burns Research and Consulting. Highlighted here are Northern California as well as the Pacific Northwest. Southern California is right below. And then, of course, Southwest here, Texas over here. And for our Wisconsin contingent, you are a part of the Midwest here. So what are the impediments to, based on what construction workers or construction experts say, to construction across Northern California? As it turns out, it's jurisdiction requirements, zoning, and lengthy delays. Exactly. Colin's right. NIMBYism, 57%. Utilities infrastructure are 29%. 14% are also approval-based and securing them. So if I were to tab into just the structure of how easy it is to build stuff, that's 71% of the reason you can't build more units in Northern California. Looking at Southern California, there's a bit more variety here. You got a nice mixture of things. And at the bottom here, you have Florida, which has just a mixture of every possible problem all at once. You have a lack of vacant land, and you have, other utilities, and then you have land deals that don't pencil for current home prices. But in Northern California, jurisdictional requirements are key still. We should have a new product. Aaron, go on. A 3-year short-term FHA mortgage, 1% federal funds, expand income standards to $200,000 a year for FHA. absolutely support that. Widen the net a bit for what FHA required loans look like. And the thing is, we do need to build units, and we do need to build affordability for units, but we also need to do things on the other side that make mortgages accessible. Why do we want mortgages to have for people? Why is this a good thing? There's a lot of research in economics that shows that, hey, when people have equity in things like their houses, they have space to actually do and build things. Global phenomenon of high prices. This is why I'm not optimistic about us finding a solution, even though we can sit in a room together and talk about it. Here's the thing, Canada, home prices have shot up drastically to a level that we've seen now. Though Canada's been doing some very interesting things. It's been very good for once for their economy. They've been bringing in tons of immigrants. They've been building their population and growing their workforce. That's good for the Canadian economy in the long run. But they've also had, they have all the same housing restrictions here that we have in the United States. And that prevents homes being built at the rate that they need to be built to maintain price sufficiency. And so Canada's extremely high in price growth since 2000. The United States is this dark blue line. We are much more expensive than where we were in 2000, but we're in the middle of the pack with regards to other countries. Only in Japan, having suffered so long and with, of course, a declining population, do we see real estate being appreciably less expensive than when it was in 2000. Now, English-speaking countries, Anglophone countries, have seen unique supply issues that are still tied to the same fundamentals about zoning, land use, etc. Total dwelling stock per 1,000 people across European countries in general have gone up. Anglophone countries, including the UK and Ireland, have languished. And if I include the change in real house prices, the United States is right up there. And you've seen a bunch of other countries, including Italy, including countries that have not had the most steaming economies lately, seeing declines in real estate, or at least have more affordable real estate than they did beforehand. So when we think about this, we still have market overvaluation in regards to how we look at the overall economy. Now, as the Fed steps away, one thing that's interesting, particularly in banking questions, is, this has come up a lot in some of the classes I've been teaching lately, is mortgage-backed securities. We know that the Fed bought a ton of mortgage-backed securities during the pandemic, and they have done so for some time. And they bought a ton of them during the pandemic because that was one of the ways they stimulated the economy. They kept the property market from collapsing, all of those things. And the interesting part is we actually saw that as the Fed sort of steps away from this, the Fed here is this proportion of the mortgage-backed securities. I love digging into things like a Bloomberg terminal, because it's like stepping back in time to MS-DOS and firing up your computer for the first time in 1989. And then, oh, look, it's Leisure Suit Larry or something. But the hard part is on this is that you've got a Federal Reserve that is stepping in to help stimulate the economy this way. They're stepping away now, but you're seeing households and hedge funds entering into this space. And hedge funds in particular are really interesting. So lots of money sloshing around. Very wealthy people put their money in hedge funds. Hedge funds require accredited investors. People with more than $1 million and a certain income level go invest their money with things like hedge funds. Hedge funds are really expensive. They often charge 2% plus 20% of profits of the annually for their services, which, by the way, underperform market averages over the long term, or the average person buying an index fund. But hey, hedge funds have started buying heavily into mortgage-backed securities because the yield profile looks pretty good. Now, hedge funds have done so in the past. We see these expansions, usually right before a financial crisis. They start building up large stocks of mortgage-backed securities, and then they unload them very quickly in the event of a recession, like in 2000 or in 2008. And so it's almost an ominous indicator in itself that, oh, who's buying these? Oh, it's hedge funds. There must be something going on. And I bet you it's not sunshine and rainbows, and it's not going to result in shenanigans overall. Looking at this, so going back to California for a second here, looking at San Francisco area and some summary Bay Area information, we've got an overall economy that is doing okay right now, still representing about, after leading the national economy for a very long period and maintaining U.S. economy unemployment rates, the Bay Area is back to basically where the U.S. is as a whole. The good news is it appears relatively stable across the board. There weren't any big swings in the most recent jobs report in August. There are some things to note. We saw a little bit of decline in professional and business services of about 3,000 jobs that were made up for, and more so by government jobs of about 5,000. Government coming in and being able to do that. Going down to San Jose from San Francisco, same thing more or less. we see a lot of stability across the economy, an unemployment rate of about 3.6%. And we see most sectors reporting month-to-month growth being pretty steady. An increase in education and health services was a unique finding in the San Jose area that went up about 1,000. But we also see a return, like the rest of the country, to greater amounts of government use as well, government employees. So that's where we are today in the economy right now, all kinds of shenanigans. This is, by the way, not only is this a clip art truck, but with the incredibly rising price of real estate prices, it will be where you'll be living as a successful programmer, as the only affordable real estate you'll have in the next 10 years at the trajectory that we're going. So it's very nice. Make sure you pick out a nice quality truck from 1987 or earlier. Used car prices are so high that it will likely still put you back more money than it needs to. So
And
question.
the guy who lives down in the van by the river now has some prime real estate.
That's exactly right. Look at that now. You look at that guy with the van and you're like, man, that's a guy who lives his life. Just put it right there in the marshes. Just, drive right down there and make it a day. You can be that guy or person.
Yeah, yep, exactly. So with all of these different pieces of information, what can our job seekers do with that as they go into their fall job searches as they end the year?
All right. So still, as I said before, there's a lot more potential things that can be downsized rather than upsides. Right now, one thing you can look at your current debt situation and where you fit with regards to how your wages are covering that. If your employer values you and you see an opportunity for an increase in your wages, do so. There's a lot of trajectory in the economy. It seems still, if we look at nominal GDP, I know real GDP has been flexible. Nominal GDP is still going downward. We're still on a generally downward trajectory, meaning that each month is slightly worse than the last one in terms of both consumer health, financing, and other things. However, be careful with your job market. Go out there, do good things, see what you can do to make things happen, and also seek higher wages when possible, and do the best you can to make do with the real estate market as it is. I don't see an immediate end in sight unless we see a decline in wages or an increase in inventories, none of which seem to be on the immediate horizon. Aaron says we could have a 2-year federal supported construction loans at lower rates. Bam, with the policy initiatives. Man, that would be really good. We also need places to build that construction, Aaron, which leads me, of course, to the question of looking back at zoning and land use ordinances and ways that we can be more efficient with the land that we have right now.
Yeah. No, we've seen a lot of interesting news lately. So like, in the past week, Google laid off several hundred recruiters, but in the same week, Salesforce announced that it was hiring another 3,300 workers about 6 months after they got rid of 10,000 people. So it's a very interesting time to be in this market. And so good advice there, for sure.
Cool. Anyone else? Any questions anybody has?
Yeah.
Anything happening?
Oh, gosh. How's New Mexico's job market going?
Well, we've got 3.5% unemployment rate, which surprisingly is one of the few areas in history we've actually fallen slightly below the Bay Area in unemployment, which is nice. Rocking and rolling, low participation rates were hobbled by low education levels and improvements we have to go for, but it's going to be a ride. It's going to be a ride. Right now, we suffer because we have a larger number of federal workers here than other states. So a lot of people do the golden handcuffs jobs, work for Sandia Labs, Los Alamos National Labs, my students. We have very few large companies or publicly traded companies. And so our job market tends to be much less cyclical, but it takes us a very long time to recover. So these are the good times, but people are always asking when the bad times are coming, and they're coming. But hopefully we can hold them off as long as we can, or at least neutralize them. So that's always the hope. And I hope more than anything, we don't have a recession. So,
yeah, Aaron says people should load up on training, local community college program.
Bam.
Yeah.
Aaron's right. Solid
so
advice.
We could all go work at Los Alamos when it gets really bad.
While you have the resources. Yes, work at Los Alamos. Come down to New Mexico. Start a small business. Well, we have a high rate of break-ins, terrible crime, education is poor, but start a business.
Sounds like San Francisco.
But less traffic. No, hey, it is like, I was thinking that last time I was in San Fran. I was like, this is familiar. I saw that same guy punching that same electrical box the same way in Albuquerque. I'm like, we have so much in common.
San Francisco, but without the breeze, the hills, and
That's right. Without the breeze, we have mountains, but it is very dry in the Presbyterian. We don't have the breeze. It's we have a different. We have either
Yeah.
oppressive April winds and dust season, but yeah, it's the same. But I love it. So much to love. Our
So
open-
one final thing, what is it that what are a few things that we ought to watch here in the next month before we meet again? What should we be looking at? Strikes, government shutdowns? What are the two
Oh
or three?
yeah. Follow the strike, follow the shutdown. If the strike's a long strike and we're still talking about the strike in a few weeks' time and it's not resolved, that means it'll have more implications for new cars, especially American cars, as it goes to the economy. And that will not have good things for, it will have good things perhaps for the workers, our hope. But it will affect prices and the availability of cars down the line, which might put pressure on the used car market. On the other side, keep an eye on government shutdowns. Hopefully the government can arrive at a solution quickly. Anytime we have a government shutdown, though, it does have a net economic cost and it does degrade ourselves in the eyes of the global economy and our ability to get things done. So not a good thing. So not enough in itself to issue a recession, but another just nail in just the sort of very slow motion downward dish trajectory overall of what's happening. Also interested in wage growth. Wage growth tapered off a bit this month. If wage growth continues to taper off or be level, I would be interested. That does indicate that we're seeing some the job market conditions are perhaps more adverse than they seem to be. If wage growth pops up again and this month turned out to be a blip, I would like to see that to be the case. UAW strikes will cost $1 billion a day from a multiplier effect. Absolutely, it will backlog trucks in the U.S. automakers. I'll really only make trucks, and trucks, of course, necessary for construction, transportation, and all those other things. So Aaron's right. It's a hit in a market that doesn't need another hit right now.
And do you foresee there to be strong hiring for the holiday season that seems to be starting soon?
Here's the thing. That's a good question. I see retailers under continued stress. I see right now retail spending is tapering off or leveled off in most categories, tapering off for younger folks. That doesn't lead me to believe we'll have an explosive holiday season. I think we'll maintain enough to keep a lot of retail establishments in line, but with price increases, it's going to be hard to see. We're at a juncture now where the price increases, the consumption can't make up for the price increases in terms of total value. And so I suspect we'll see continued declines in profitability. And if profitability declines like the ones we've been seeing happen again quarter after quarter, 2 quarters from now, we will start seeing jobs and other things affected in meaningful ways. Retailers are getting smoked. Sporting goods is an awesome indicator, and they have been crushed the last 30 days. Aaron, I think you're right on the hammer here. I'm going to look. I'm trying to hedge a little bit on my suggestions, but it's going to be a rough ride this holiday season. And I think after the holiday season, if it is disappointing, you're going to see more retailers shutting the doors, looking at other things, looking at other bankruptcy situations. It's going to be a Hail Mary for a lot of retailers out there this holiday season.
I think one of these future months, we should definitely talk about the future of the American mall, because that's also a very endangered species right there.
Oh man, can you imagine what an amazing thing malls were a couple decades ago? They were so cool.
Oh yeah,
places, right? They're things.
It's where you went to go get your Cinnabon while buying your clothes, while running into your friends.
I know. Used to be
And
a
now
place
it's
to
where you
hang
go
out.
with your Amazon app to scan for prices and find something lower online.
Now I feel like I gotta come there. I have like my knife out. I'm like, am I gonna be stabbed? Is it today? Is it tomorrow? And what's this? And I have like 20 stores I haven't heard of that have no one in them. And a lot of open storefronts, a lot of other issues, but also a lot of hope in repurposing these establishments to some varying success. So you've seen a couple of this happen probably in projects near you. But it'll be interesting to see how malls can adjust from being a retail focused establishment to an experiential focused establishment. What do you do with all that space? And how do we convert that space into things that people need right now? So,
or you do what the one in Minnesota's done for years, where you put a big water slide in the middle of it and you hope people go shopping at the food court later.
That's our solution for higher education here in New Mexico too, is water slides. So I'm going to put one in we'll be the only business school with an operating water slide. It's going to be great, and it's going to be fantastic. It's going to be
put some more money in the University of New Mexico football team, right?
That's
you win a few big football games, you get some billion-dollar payouts, and before you know it,
That's exactly right. Who knows? It goes right to the water slides, and then it's just It's just the water slides reinforce. People come for the slides. Should have to prime. Should have hired Prime at UTEP. Oh man, fake session. One
Yeah.
for build up demand, clear rate summer, then bam, we rip 2H 24-25. You think so?
Yeah.
That's interesting. So our fake session, 1.5% growth recession. I like that. I like that optimistic forecast, Aaron. I appreciate that. Solid. So Aaron's got a nice forecast here. He's looking at it. I think that's pretty good. Looking at inventories, rates peak summer 24, then bam, we rip second half 24-25. I think we could get out of this. If we get out of these doldrums and we turn if the credit quality trajectory starts improving, damn, I will also sound the growth hammer. I want to see when we do it. And I think you're right.
And just looking, right? University of New Mexico, 1 win and 2 losses on the season so far. So
we got one
there's still
win
time
though.
to turn it around. Still time to turn it around.
I'm not, fortunately, the football team's out of my purview, but that's a good allegory for the rest. It's a good allegory. Man,
All right.
one of these days. Thanks, Albert. Thanks, everybody. I love it. Prime
Absolutely.
is fire right now.
Oh, goodness. I love a good football reference in here. And, you know, if I heard on a podcast today that if Deion Sanders had showed up a couple seasons ago, the Pac-12 is probably still around. But that's not really for this webinar, but that's what we're throwing in there.
Footballonomics with Albert coming up.
Exactly. So for all those of you who joined, thank you so much. We appreciate it. We will have this again next month as the economy turns. And we look forward to your insights. We look forward to your thoughts. And we will see you again soon. And this will be up on our YouTube page in a couple of days as well, if not less. Thank you all so much. Best of luck on your job search. And we'll nerd out with you next month. Bye, everybody.